So I just want to thank, obviously, Di for the introduction, and on behalf of Gallagher and Finlaysons, I'd like to sincerely thank the crew at Bioenergy Australia for the opportunity to provide some insight into identifying insurable projects, along with the contractual obligations and practical tips to assist you in the journey. Obviously, we've got limited time for today's webinar, so we'll keep our presentation focused on third-party risks only, but we'll be happy to answer, obviously, any questions at the end. And our contact details will obviously be available should you wish to make contact with either myself or the other presenters at a later date. So as Bioenergy Australia has developed a conceptual project development timeline, we felt it would be most appropriate for us to formalise our presentation using the same timeline to demonstrate the various stages and the relevant appropriate insurances and contractual arrangements. Lauren, if you want to move to the next slide for me, please. Okay, now the slide's not coming up. There we go. There's the slide gone. I think we've got some technical issues here. With the presentations disappeared.
Apologies, I'm just going to fix it. One moment.
Looks like we've got some audio issues. Okay. If you can go to the next slide for me, Lauren, that would be great. Okay, so this is the conceptual project development timeline that obviously you would, as members, have likely already seen from Bioenergy Australia. So we're using the same timeline for today's webinar so that we can send you through the same various stages, and so that you can see the relevant appropriate insurances and contractual arrangements that you'll need throughout the lifetime of the project. These are obviously pre-feasibility, project development, construction, operations and decommissioning if in fact the project is to be decommissioned. If you want to move to the next slide for me, Lauren. And we'll bring in Sam Jennings, who will speak to us now from Finlaysons.
Thank you. Thank you, Bron. So pre-feasibility is typically the fatal flaw analysis phase of the development timeline, where you're assessing the different streams of your project and looking at what could potentially kill the project, essentially. So we've put multiple streams up here as a little bit of a checklist for those of you who don't already have sophisticated risk assessment processes and systems in place, to enable you to see the streams and tick off on the different types of risks that could arise, which could cause a fatal flaw for your project and stop it from proceeding. So typically when you're at this phase, what you're doing is trying to have your investment committee or the powers that be approve investment in the project, and they'll be looking to make sure that you've covered off on any key risk items or red flag items which could prevent the project from moving on to the next stage in the project development timeframe. The challenging thing about any project development process like this is trying to make your streams align and time together, and that's the art of development, or #devlife, where you've got EPC, you've got connection agreement, you've got financing and PSCAD modeling or GPS, generator performance standard streams, all going at the same time, and you're trying to make them all line up. And I guess for the purpose of this exercise, without reading all these checklist items verbatim off the screen, a key item will be insurability. And if there's a fatal flaw in the insurability of the type of project that you are doing, and this is where it's a really good segue over to Gallagher, because there are risks that are of particular relevance for this type of project, particularly when you're dealing with waste facilities and those sorts of things. So I might just segue and hand over now. I think it's to Brett.
Mm-hmm.
Yep, thank you, Sam. If we just go to the next slide, thank you. So look, there's a number of insurance considerations for the bioenergy sector. The positive news is that the insurance market is supportive of your industry, and forward-looking insurance companies have been electing to withdraw from writing coal risks and fossil fuel risks, or have made a commitment to phase them out, given the proven contribution to greenhouse gases. So insurance companies and their actuaries in the background, they understand that climate change has a significant impact on the insurance industry, and a warmer planet actually results in an increased frequency of natural disasters. So Hurricane Katrina, as an example, cost insurers $60 billion. And it would be contradictory if insurers were paying claims for these types of losses, but then supporting coal power and fossil fuels at the same time being a key contributor. So yeah, they're starting to phase out those types of risks. Australia is home to some of the world's biggest directors and officers liability claims, and climate change and shareholder activism is really topping a list of challenges that companies will face this year and beyond. And insurers really have concerns that these types of claims will be directed against boards that fail to address climate change and climate risks, and have stopped providing insurance solutions for these types of companies. So the good news is the insurance industry is on board with your industry in the clean energy space. The bad news, we're currently in what we call a hard insurance market cycle. And a hard insurance market is characterized when insurers all follow the same strategy of increasing their premiums to correct loss ratios, and they've got a much stricter underwriting appetite. They're tightening their terms and conditions, and they're really selective with the risks that they choose to write. Insurers are naturally cautious at the best of times, and in this market, consideration of new business, particularly startup technology that doesn't have a proven track record or proven financial success, it can be difficult to get the insurer's interest and appetite to come on board and write the risk. And this is where working with an insurance broker that has the expertise will really pay dividends. So we really get the best out of insurers because they know they can work with us. And when we spend time with our clients and really understand what it is that can turn the argument with the insurer, we often have another shot at improving the outcome. We try to be persistent with facts and reasons, and that's what makes us effective and gets us the best results for our clients. Now, the ugly, waste is generally categorized as a really poorly regarded by insurers, because there's been a number of recycling plants that have suffered heavy losses, 10 factory fires, I think, at least in the last 18 years. And as a result, recycling plants have basically become uninsurable. And that's the characteristics of a hard market when you can't place a risk anywhere for any price. So our role in the market is to differentiate your business, and so that insurers don't give you the same standard approach that apply to a sector and a general classification, because clean energy and bio risks are obviously not the same as a recycling plant, and your insurance broker really needs to articulate that clearly to explain there's a big difference, and you don't want to get lumped into a recycling labeled business. Look, insurers are pretty slow to develop new products, and there's a number of different associated risks that bioenergy face, and there can be the potential for gaps. But Chubb is a leading technology insurer, and they're an example of one insurer that has produced a specific insurance policy for clean energy and energy efficient technologies that combines professional indemnity, cyber, privacy risks, and public and products liability all in the one package solution for a much more seamless approach. The last thing you want is two different insurers with two different policies pointing the finger at each other as to which policy is going to respond in the event of a claim. So taking this holistic approach with one insurer certainly has benefits. On to the next slide, please, Lauren.
So I'll pick up from the next slide. One back. You go back one. There's one back before that. She changed around, didn't she? Yeah, that's the one. So as both Sam and Brett have indicated, the first discussion that needs to occur is in relation to the startup project, is it insurable at the outset? So that obviously determines what happens next. These discussions, though, should occur not only with your legal team, but they also need to be in conjunction with your insurance broker. Together, you can make that determination whether the project is actually viable or not. And whilst, you know, as Brett said, most insurers are keen to support green energy in principle, there's obviously many factors, and obviously we've set out some there on the left-hand side. And obviously one of the first ones is it unproven? Is it untested? You know, are you going to be able to convince an insurer to take that risk on? Is the location of the project, is it close to in a bushfire area, or is it in a floodplain? That's also going to have a massive impact. Also, if it's right next to a residential site, and is that going to have pushback and no engagement from the local community? Does the development team have the credibility and the experience to actually bring this project to fruition? And is there appropriate contract terms in place with landowners who obviously have to be on board with this as well? And all of these factors come into play. And on the right-hand side, you'll see that table, which is what Brett alluded to, which was the recycling, which has obviously become a bad word and a subject that most insurers don't want to discuss because of the volatility and the assumption that fires are always going to occur at a recycling plant. Now, obviously, recycling plants have changed over the years and they're not what they used to be, but they are still a massive concern for insurers. So that's where it's imperative that the discussion you have with your insurer indicates that you're not a bad risk and you're not a recycling risk, and that therefore they'll give you the opportunity to provide your details on your project and get it through to an insuring stage. So if we want to move to the next slide, Lauren, and it's back to you, Brett.
When it comes up, I won't spend too much time on this next slide, but it's just a diagram which shows the insurance market cycle that I touched on before, which is a cyclical cycle. So I mentioned previously we're in a hard insurance market, and when the slide comes up, we're currently at the 12 o'clock phase of the diagram, and that's where we see high premiums as insurers are trying to regain their profitability because there's been a lot of natural catastrophe and disaster risks that have hurt their property portfolios, combined with D&O insurance for ASX listed companies in our emerging class action environment, construction, financial institutions. There's quite an array of different pockets that have hurt insurers, and then coupled with record low interest rates, insurers just aren't making money. So that's what enters the hard insurance market that we're in. I think we're still struggling to get to the next slide to, here we go, oh no. We'll get there. But what does tip the scales eventually of the market is some new capacity providers come into the market. They're attracted to these record high premiums and they don't have the legacy claims issues. And then when you've got a bit of competition coming back into the marketplace, you re-enter the soft phase. Here it is. And then eventually we'll get down to the 6 o'clock position on the diagram where we see lower competitions, lower premiums because there's more insurer competition, more capacity in the marketplace, and much more favourable buying conditions for you. So that's just a quick snapshot of the insurance market. We think it's a couple more years before we'll get to that soft market stage, but some capacity is just starting to creep into London, which will soon have some positive effects on Australian business. And yeah, a couple more years of pain and then it'll start to correct, we think.
Okay, this is back to my slide. So we've passed through the pre-feasibility phase and the development timeline because through excellent work of your insurance broker, they've convinced the underwriters that it's a positive project and an insurable project. And what we've done really for the purposes of this exercise is to assume that we have a grid-connected waste gas generation facility as a bit of a case study. obviously there are a huge number of different types of iteration to the types of projects we're talking about, but that's what we thought we'd use as a little bit of a case study here to sort of make it a bit more visible, a bit more practical. So you're through pre-feasibility and you're looking at development. Development is when you're literally starting to put things out to tender, talk to EPC contractors, negotiate with your grid operator, whether it's your TNSP or your DNSP, and you're starting to look at who is it that could actually cause me or my project damage and who could I cause damage to. So really what you need to do in this phase is identify what your risk interfaces are. And when we say risk interfaces, it's the parties who can cause each other damage. And then once you've identified what your risk interfaces are, you need to have a think about what is the category of risk interface that I'm dealing with. And what we've done for the purposes of this is break the categories down into two broad categories to keep things simple. Essentially, you're going to have interfaces that you have a contract with, EPC contractor, grid operator, waste facility owner, and you're going to have risk interfaces that you don't have a contract with, such as third parties who could come onto site, neighbouring businesses who could be affected by fires that emanate from your facility, and those sorts of things where you're going to have an uncapped common law exposure. So if we can go through to the next slide, please, Lauren. We thought we'd try and make that exact scenario visible. So right away, as a developer, looking at this this image up on the screen, you can identify who your primary risk interfaces are, and you can see how they'll be interacting with each other. So you've got your primary interfaces being your EPC contractor, who will obviously be on site undertaking a large amount of the works that are involved. You've got your grid operator, who will typically enter into a build, own, operate, maintain type arrangement where they will outsource construction of their assets to a D&C contractor. You've got your waste facility owner, who could be susceptible to fires or other pollution emanating potentially out of your facility. And then moving into the operations phase, once construction's been completed, you're going to have interfacing between O&M contractor and grid operator. So your secondary interfaces here, as we mentioned before, are the deeper network users. So potentially there could be an electrical surge from your plant that causes deeper network issues and prevents a neighbouring facility or heavy industry facility from having access to energy for a period of time. Neighbours who could be affected by fire, and trespassers. I've actually seen a scenario recently where some kids came onto a site and climbed up a transmission tower, fell down and hurt themselves, and it's caused issues for the client for years after that event had actually occurred. So once you've identified these risk interfaces and whether or not you have a contract with them, the next step is sort of understanding contractually or forming a strategy as to how you can mitigate or control the risks that you will have. And to keep things really practical, I mean, this could go into a 100-page risk assessment spreadsheet. We'll try and avoid doing that. But to keep things really, really simple, it's going to be a matter of essentially working up a loss event schedule to say, what are the key heads of liability that I could be exposed to or I could cause? Can I cover those exposures contractually? If I can I then have a secondary mitigation, which is insurance? And then the second ones are, which cannot be controlled or mitigated contractually, such as the true third-party risk that we've discussed. Am I appropriately insured for those sorts of things? So it really is a practical checklist process. Identify your interfaces, identify the category of interface. Do I have a contract? Can I control risk contractually? And then step 3, identify what your mitigants and your controls are for your risks and your exposures. And I guess one other thing that I'll just, if I could go back, sorry, Lauren, to the previous slide, just to close off on this is the different approach to risk from different project counterparties and stakeholders. So obviously, as a principal in this type of project, you'll have the ability to pass a lot of construction type risk in terms of losses caused during construction onto your EPC contractor. And I think Sam Burford will be discussing different ways to do that contractually. Typically you see different limitation of liability type arrangements in place for those sorts of things. But you need to also consider, and I think one really practical tip here is considering how the grid operator is going to be considering the different risks involved. In my experience, the grid operator is very risk averse and not prepared to take on material liability caps, which would be the type of cap you'd expect to get from an EPC contractor. So you really need to think about, if I'm dealing with a monopoly grid operator provider who's not prepared to take on risk, how can I approach some of these risk assessment or risk control mitigants operationally? And I think a lot of the time that can be done through early engagement with your insurance broker in order to understand how you can control some of these risks rather than through contract with the grid operator through your insurances. Okay, so ready to go on to the next slide, Lauren. So the next slide's really essentially another checklist item for the participants in this webinar to have a think about who are the different players in the different phases of my project. Obviously, you're going to have different risk profiles during construction where you have multiple contractors on site who are interfacing with each other, which would be sort of the time where you have the most activity and the most interface risk with different contractors on site, compared to the operations phase where you're going into long-term operations and you have less contractors or less of a presence on site in terms of who can be damaging each other. So run through the checklist, identify who these interfaces are, and make sure you have a strategy for controlling the risk, whether contractually or through insurance.
And actually, just on that point, one of the major factors with this is in the construction phase is, as principals to the project, it's really important that you take on a principal controlled project insurance policy to ensure that you've got protection for the financial consequences of a delay in startup, rather than relying on the contractor who can really only cover around 10% of your liquidated damages of the contract price. So it's really important that you control that whole process if at all possible, rather than rely on the contractors. And lenders also will see delayed startup cover as extremely important when they're, as far as their security package for the project as well.
Yeah, and also, another interesting point just to finalise and to sort of tack on to what Bron was saying is, if you have your principal controlled insurance policy pay out on a risk, it's also important that insurer's got the ability to be subrogated and then potentially go after the contractor and the contractor's insurance. So the two do work together, and it's important to make sure that in your risk mitigation strategy, you've considered those two things and those synergies. So we'll hand you over to Sam Burford, who's now going to have a bit of discussion about construction contracts and a few tips as to how we can control risks contractually.
Yeah, thanks, Sam. Look, I can't see the slides there, but Lauren, assuming that you've now got that bit of a spreadsheet that's titled Phase 2, Steps 3 and 4. The purpose of this was just to give you a bit of a snapshot as to what type of losses you could experience on the job, and how, from a contract lawyer's perspective, we look at drafting the contracts for you in a way that tries to minimise your potential risk exposure, which you'll see there as the middle column after the examples, and then also the related insurances that you should have in place in relation to these particular events or potential losses for your project. We don't want to go into a huge amount of detail, given obviously every project is unique, but there are obviously some key issues we see all the time that you want to seek to minimise your risk on for any type of project. And this slide deals with the property damage and personal injury risk. Obviously, during the construction or operate and maintain phase of the project, there is a significant risk of there being some sort of property damage or personal injury on site. And you'll see each of these under the contractual mitigants. I've kind of got some similar headings underneath both of those, because essentially the same type of contractual risk mitigation strategies equally apply. So first of all, indemnities, just to explain what that means, there's always the issue of without your contract in place and assigning risk, that the way that the law will interpret your risk is based on who's the relevant party who's had the duty of care and done something that's wrong, rather than, and something that's foreseeable, rather than something that might have happened due to no cause, due to a neutral cause. An indemnity that basically says in your contract that the risk is assigned in relation to any property damage on site to the contractor who's constructing the facility, makes it clear that regardless of who's at fault, then you've got coverage against that contractor. It also ensures that the losses that you might be able to recover as a result of a property damage whilst an insurer is building can extend quite broadly to potential consequential losses. So it's important to have an indemnity clause in your contract to cover you broadly in relation to that. As a consequence, you'll always get a contractor that pushes back on that and tries to put limitations on what that indemnity is, and to a degree, that's understandable. They can only take so much risk on a project. And one thing that they will try and do is to put a cap on what their liability might be for any type of property damage or personal injury. It's a matter of assessing your project and as to what cap you might be prepared to agree to on what that contractor's liability might be, considering in particular what losses you could possibly envisage if property damage occurred which delayed your construction significantly, or resulted in the need to do reworks because a fire or something or other means that what was a 60% complete job is now back to 10%. So that's an important one to try and negotiate and agree something that's reasonable for both parties. It's also important and negotiable with a contractor to try and exclude third-party claims from a contractor's liability cap. For example, Sam mentioned before that a grid operator is quite risk averse. Well, if there's any claims that a grid operator could make against the facility owner for not having the facility available to provide energy at a particular point in time, well, who's to take that risk as a result of that property damage? Well, having an exclusion in your contract that provides that any liability cap doesn't extend to a grid operator claim can be a useful way to still minimise your risk despite that cap. Excluding claims from the contractor's cap when insurance responds, and this is obviously where the overlap with Gallagher's arises, because there will be the potential to obtain insurances on behalf of the contractor that might actually respond more than what that cap is. So a contractor might be prepared to therefore agree for that cap not applying if their insurer is going to cover the loss anyway. So teeing that up and making sure then that the insurances match what the contractual framework is very important. Proportionate liability legislation, without going into too much detail into the law, what we see with from a construction in the construction legal industry is sometimes there is a claim that an owner has against a contractor for some kind of issue that's arisen on site, and the head contractor might seek to say that they're not responsible or they're only partly responsible for the problem. Then an owner is then in the situation of having to go after, say, 3, 4, 5 different parties. Might be, an individual, a designer, an engineer, and the contractor, to try and say that they're all responsible and for 10, 20, 30% of the problem. Being able to point the finger at one party is therefore fairly crucial, and excluding the legislation which allows a contractor to be able to say, well, I only partly caused this problem, so you can only therefore pursue me to the extent that I contributed towards it, is an important exclusion to have in place. Those same type of I won't go through the personal injury one as well, but those scenarios, as I said before, equally apply, other than there are some limitations on the way that you can assign liability just for one party for losses or personal injury claims the law, there's I guess a bit of a tension there where legally the legislation wants the person responsible for causing an injury to a party to be appropriately liable for that, and not based upon what the contract says, and that's why there's some limitations in place on that. But if I could move to the next slide, then Lauren. The last example that I want to give there is in relation to pure economic loss. I'll give some examples here of what type of issues could arise during the construction phase or during the operation phase that might cause you economic loss. The example here is a design error that might then mean that the facility is not able to generate, so it's effectively not fit for purpose. Again, the types of clauses that you want in your contract to protect you include the indemnity provisions, appropriate limitations on a contractor's liability cap, and some limitations on the contractor to be able to apply proportionate liability to limit their exposure to that particular loss. The only thing different with this slide here is you'll see there in liability cap, there's another exclusion or a couple of other exclusions that might be worthwhile looking at including for economic loss, and that is any cap should not apply to anything that the contractor does that is grossly negligent or reckless, or that they really should have avoided, but they were effectively indifferent to that. Then there's the expectation there that the contractor will pick that up. Their limitation would only apply in the event that they were unknowingly negligent in their failure that resulted in that loss. We've got the insurance component there in the far column. As I say, it's important when setting up your contract to make sure that your insurance is aligned with what your contractual risk is. I don't think the intent today is for Gallagher's to go through each of those potential insurance policies and how they apply, but it would be too much to cover in one session. But the point was just to reiterate that it's just important to make sure that both your lawyers and insurers are speaking during your procurement and contract drafting stage. The next slide there is mitigation by contract practical tips. I've worked through these predominantly already when talking through that table there. The only other things to mention are probably in my third dot point there in relation to excluded risk. There likely will be some pushback from the contractor to say that, well, we're not going to take complete responsibility for everything that happens on site in relation to property damage and personal injury if you as the principal do something that's wrong that results in that property damage or personal risk. And look, that's understandable. It's just a matter of making sure that that's limited to a negligent act or omission by you as the principal, and it doesn't cover anything such as property damage caused by neutral events such as weather or flooding or fire, etc., which you'd obviously want coverage from the contractor for. The last point on this slide is latent condition risk. Now, this is probably a key risk for projects of this nature, where the soil profile might be somewhat unknown, and you want to make sure that the latent condition risk runs with the contractor. Well, there might be something in the contract that provides that the contractor is entitled to some time relief if some unexpected materials are found on site, but it's just a matter of if that does go in there and you do accept that as a limitation or exclusion, that it doesn't extend to and cloud the risk that the contractor is responsible for property damage and personal injury related to any latent condition. Next slide, please, Lauren, just relates to the potential losses that might occur during the design stage. You would look, there will be situations where you engage a designer before then engaging a contractor to deliver the project. it is advisable to get the designer to then contract directly with the contractor, to provide a direct right of recourse then to the contractor for all things. And in any event, regardless, to make sure that whoever has design responsibility is providing some type of warranty to the extent possible that what they are designing is going to work, and that then you're covered for that, and also consider whether or not that might be insurable. Ways to also mitigate against design risk are trying to put limitations on extension of time rights and strict completion dates, so that if there is a design issue or even a fault during construction, that you've appropriately captured your losses there by having some pre-estimates of what your losses might be in a liquidated damages provision for any day that the contractor or designer is late compared to the completion date that's in their contract. And the last note here is we're obviously focusing today on insurable risk. So I'm not going into issues such as how to protect yourself by contract in relation to other delay or variation risks or time bars, etc. In a contract, but obviously those things would need to be considered as well at the drafting and negotiation phase. Next slide, thanks, Lauren. And I think this is a hand back to Arthur J. Gallagher on mitigation by insurance.
Yeah, thanks, Sam. So we were obviously recently appointed to a large renewable energy client, so we've got a really clear understanding of the appropriate action that needs to be taken by all clients when marketing themselves and their project to prospective insurers. It's actually imperative that if you want to achieve the best outcome on premium coverage and insurer buy-in, they need to understand what you do. So your insurance broker shouldn't be averse to introducing you as the client to all prospective insurers, so that you can then provide a first-hand knowledge and an in-depth explanation to sell yourselves and your project to the market. Your insurance broker must have a comprehensive understanding of your project to ensure they can engage the greatest number of insurers to make themselves available for a market submission. So it's imperative that you go with a white piece of paper and you sit down with your broker and you tell them everything so that they understand it. Because if they don't understand it, they can't sell it to the market. So once you've done that marketing submission, and that means getting your insurers in the same room as you and actually talking through exactly what you want to do and how you're going to do it. Once you've done that, you then will have a really good indication as to whether insurers are interested and whether they will then be willing to provide a program for you. So then once that's done, you can then go through and do your insurer selection process, and hopefully what may have at the beginning felt like a project that wasn't going to occur is definitely going to happen. Brett, over to you.
Yeah, just adding on that, look, everyone at Gallagher, we've all had difficult client conversations over the past 12 months regarding premium and coverage changes in this difficult market we're in. But what our clients remember and value is how we prepare and guide them through this. We're asking our clients for a greater commitment in time to help get them the best outcome. And gone are the days when you can complete a proposal form at the last minute and ask your broker to make sure the cover's in place the next day. It's a much more detailed process, and we really encourage those tripart relationships with your insurer partners. As Bron said, no one can sell your business better than you, so those face-to-face relationships are key. And the other part of that relationship equation, of course, is having an experienced legal firm like Finlayson's, and really important, you're engaging your legal advisor and insurance broker early so that we're all on the same page, that the risks are all considered and appropriately covered off before any loss or claim occurs. Insurance always needs to be the fallback position.
Next slide.
So look, appreciate this is a busy slide. And as Sam said, we don't have time to cover off all the different insurance products that are out there, but this just gives you an overview of all the different types of insurances that are available over a project timeline. Bron and I are happy to take any specific policy questions when we go to the questions shortly. But really, before your insurance broker can provide any advice about your insurance program, it really all needs to start with a risk profiling exercise. So this is where your insurance broker would work with you to really understand what the risks are, what your risk management philosophy is, what your tolerance of the variance risks are, and help quantify worst case scenarios to then ultimately build a bespoke insurance program. So you can have comfort that you've got all the appropriate policies and all the levels of cover are in fact adequate. And then we also structure the insurance policies with tailored financial deductible levels that match how much risk you want to retain. So some clients want to take on more risk and have more of a catastrophe type cover, while others want to make sure their insurance policy responds if the loss exceeds a low amount. So again, it's a partnership, and that's where we work closely with you. It's a fluid process, and we'd always revisit that risk profiling with you to make sure the insurance program is constantly evolving and staying fit for purpose. So over to the next slide. I think it's really just a wrap up, and I'll close and just say, look, both Gallagher and Finlaysons have a really strong culture of committing to our clients and taking the time to understand their businesses to make sure the advice that we're providing really identifies and covers off all the risks, new and emerging, and that might not have been considered previously. So hopefully it's been evident, everyone listening on the call today, that there is deep expertise in this bioenergy sector from both Gallagher and Finlaysons from the legal and insurance perspective. And we've got a lot of knowledge that we're happy to share with you with our growing portfolios of clients that are in this space. We'd be pleased to be of service to anyone on the call today, and we thank you for the opportunity to present, and happy to take any questions. So I might hand back to Di.
Thank you all. Thank you all for a terrific and integrated presentation. I think that what you've done is really opened the window into the world of risk and liability, into risk identification and management of liability, and I think that's been, well, for me, quite an eye-opener. And particularly significant is the impact of all of that risk management practice on the long-term financial feasibility of a project and its commercial outcomes. What I'd like to do